There is a correlation between weakness and liquidity. Therefore, liquidity is not always associated with the economy. In fact, it frequently comes before it. As an illustration, the most liquid assets were acquired in the early 2020s, prior to the economy's collapse, when it received some of the largest ever infusions of liquidity. That is why there are instances when assets driven by the economy and those driven by liquidity diverge. So when it comes to stocks, for instance, many of the major tech companies are quite pricey, especially when you consider them outside of the top 7 performing as stocks. On the other hand, cyclical equities such as US value stocks have performed poorly over the last year, reflecting a generally worse economy. The Manufacturing Purchasing Managers Index is below 50. It seems like the Conference Board leading indicators are giving us some pretty bad news, isn't it? Thus, many aspects of the economy are delicate. Then, as you mentioned, both China and Europe are quite pliable. There is a great deal of global economic weakness as a result, but that's partly to blame for the increase in global liquidity. Many governments have felt the need to inject more money into the market, even while they're still fighting inflation. By highlighting the complex connection between liquidity and economic health, Lyn Alden has drawn attention to an important facet of our present economic situation. Alden highlights the possible difference between assets affected by liquidity, like specific stocks, and those more directly related to economic performance, using the events of early 2020 as an example. Massive injections of cash happen despite economic challenges. While these injections of cash may help in the short term, they do not always reflect a strong economy. Indicators such as the Purchasing Managers Index and the Conference Board's leading indicators, which imply softer economic conditions and the increased global liquidity, both lend credence to this idea in the current economic statistics. Important areas such as Europe and China show the most difference. Diversification, according to Alden, is key for investors in current market. Big tech companies may be resilient, but cyclical stocks might be a stronger indicator of the economy's overall malaise. To weather possible market swings and uncertainty, investors must keep their portfolios well-balanced and diversified, since liquidity and economic performance don't necessarily go hand in hand. During the first 3 quarters of 2022, the full effect of the tightening was apparent. As a result, interest rates were rising while the Federal Reserve's balance sheet shrank, and neither the Treasury nor the fiscal side were able to compensate. Almost every indicator showed that the economy was slowing down, and assets were no exception. However, the offset between the Treasury and the Fed began in the 4th quarter of that year. To promote liquidity, they initially started reinvesting funds from the Treasury General Account, a practice that lasted until May of last year, 2023. They were able to withdraw funds from the reverse repo facility and re-establish them in the market by shifting their focus from long-term bonds to short-term ones. Consequently, the two kind of steps taken by the Treasury have more than compensated for the liquidity loss experienced by the Fed. That helped the dollar index, which was good for American and international markets to a lesser degree. Also, a lot of the world's debt is in dollars, as you may be aware. Therefore, many of those businesses feel the pinch as the dollar gains ground against other currencies. The worst-case scenario is that you have assets denominated in the strong currency and liabilities in the weak currency. However, the dollar index has been trending lower since that precise period in the 4th quarter of last year, providing some relief to economies throughout the world. That was one major consideration. Second, the interest rates were intriguing as they were unexpected. One is that there is a lot of cushion to get through it because there is just a lot of liquidity and additional cash in the system. Additionally, a large portion of the debt held by homeowners in the middle class and upper middle class is fixed-rate mortgage debt. Again, a lot of that is low fixed rate for investment-grade firms. Thus, these entities have been largely unaffected by it. This is most noticeable among the working class and lower middle class, as well as small firms, non-investment grade corporations, and individuals who rely on credit cards. Short-term bank loans are common among these groups. Regrettably, some of these measures have a greater effect on them. The federal government's own debt, strangely, has a very short term of around 6 years. This has a lengthy tail that extends up to 30 years, with a lot of it happening in the first couple of years. Therefore, during those initial several years, they serve as real centers. As a result, interest expense starts to explode. The interest expense and the government deficits are actually someone else's surplus, which is something that many people don't understand. Thus, they may be making their way to offshore investors who own treasury debt, or they may be making their way to onshore investors with money market assets, T-bill exposure, or any type of bond with a medium or short maturity is performing well. On a national scale, equities and real estate values have begun to rise again, which has a positive impact on wealth. We were able to overcome that in large part because of that. Again, the problem was that many individuals in early 2022, myself included, wondered if they could increase to 5 without causing everything to explode. Oh, most likely not, we would have responded. However, I believe that the most important thing is to react to information as soon as it becomes available. Alright, you ask, what is occurring that I didn't necessarily anticipate? Also, how is the chain of events unfolding? Because of this, adapting to the situation as it unfolded was crucial. Though it has been quite helpful to look to the 1940s as a model, I can't promise that everything will unfold in a linear fashion. Having that historical analog and then updating what's happening monthly or quarterly is what I find most useful. To put it simply, there are pools of debt financing available. Among the most notable are reverse repos and the Treasury General Account. As a result, bond sales and tax collections go into the Treasury General Account, and funds are deposited into the Treasury General Account, which serves as their equivalent of a bank account with the Federal Reserve. They call it their cash balance or working capital. The government as a whole is always spending money on many things. Thus, there is that float that they maintain continuously. So, for example, if the government issues a flood of bonds or has a large tax season and takes in a lot of money, but it takes a long time to spend it all, the economy ends up losing money. Therefore, that capital is simply sitting there doing nothing. The system has already removed it, but it has not been reintroduced just yet, because that's capital that's been removed. The larger that is, all else being equal, the worse it is for liquidity. Also, the opposite is correct. All that money will be pushed back in if they lower it. They are reinvesting tax-free funds into the economy and are issuing new bonds to raise more money as they've used what they have. At the same time that it is being installed, it promotes liquidity. And typically, they aim to maintain a fairly constant balance, a few $100 billion. In that, naturally, they have increased it in response to the ever-increasing figures. Everything is getting greater, including the deficits and nominal GDP. Therefore, they aim for a larger target, but they do their best to keep it relatively precise. However, the debt ceiling was the catalyst that really accelerated that. Once they reach the debt ceiling, Congress tells them, okay, you've hit the debt ceiling. This is one of their responses. You still need to pay your bills, but you are unable to issue additional bonds. Thus, picture yourself in the shoes of a homeowner or other household member who has lost their income but has funds to fall back on. Starting to pay your expenses with the money you have saved is your only option. That is the function of the trap. They continue to spend without increasing their revenue. As this is taking place, the influx of capital into the economy is being stimulated. Dead money coming back in is number one. So that's that. 2, while they are similar, the reverse repo is different. The Federal Reserve executed more quantitative easing with debt than was necessary in the past since they were so aggressive. Because of this, there was a substantial amount of spare change that would have been better off in T-bills rather than a bank. With T-bills, the federal government, not a private bank with $2 million in FDIC insurance, will back your money. To that end, T-bills are in high demand. The Federal Reserve was hoping that the influx of more capital would keep 10-year Treasury rates above their target rate. In a twist of irony, there would be an oversupply of T-bills. That is not what they desire. So they decided to build this new facility where people could deposit cash and borrow T-bills at a rate that was somewhat higher than their lower bound. This would be a better alternative than pushing T-bills, which would lead to fights and interfere with their capacity to be aggressive. Therefore, it's like an additional hole in the budget that yearns to be filled with T-bills, but is unable to do so at the moment due to a lack of supply. Not to mention that it has no interest in banking either. The government was able to drain this facility's funds and inject them into the economy through the massive issuance of T-notes, leaving behind a hole that functions similarly to dead capital. It's merely spare change that longs to be in Treasury notes. The money is actually spent after being put into T-bills. Thus, once again, they are able to raise revenue without depleting bank reserves. Money from savings won't cover it. The source is the already void reverse repos. Therefore, it promotes liquidity by reintroducing it to the system. Hence, the two stages. The first was the TGA phase. The second one was the facility for reverse repossession. Quantitative tightening by the Federal Reserve was mitigated to some extent by their combined effects. Because these net effects have been somewhat larger than the Fed's projections, bank reserves are presently higher than they were at the start of 2023.